Okay, we got US home prices accelerating at their fastest pace in the past 2 years. Today is the last Tuesday of the month. It's October 27th. And with the last Tuesday of the month, what is it? It's Case-Shiller data time. So we're going to review some of the Case-Shiller stuff today, talk about some new housing and some other aspects of the housing market. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns and Burns and Churns and keeps going up and up and up. Do we have a V-shaped recovery? Do we have a different letter of the alphabet we're using? We'll find out shortly. I'm Randy Patrick, your host, putting the realism back in real estate. Housing bubble bro versus housing hype hack. That's, I guess, what we're talking about these days as well, too. Seems that we've got a lot of people who are commenting on the housing market. If you actually look at the amount of videos that are out there, I started my channel about 2 years ago with a different purpose to where it's ended up today. And, I was one of a few people that were talking housing bubbles. And now you can just type in housing bubble in the search and you see, or housing crash, whatever, and you see tons and tons of people who've jumped on the bandwagon, who are commenting on it, which is, it's part of the game plan. It's part of what goes on in the housing market. So, and people who are trying to, whatever, stake their claim or provide their information or do what they want to do in the marketplace. But anyway, the point is, we're getting a lot of opinions on this. And, are you for it? Are you against it? Do you believe it? Do you think it's foolish? What's going on? It's a tough call these days. We have almost like a split market we're looking at right now. So I want to be clear. I was pretty much housing bubble all the way around, but now I'm seeing, I'm really sort of going down to these split markets where, we basically have some markets doing well and some will not. But again, it's artificially controlled right now, and we don't have foreclosures or things hitting the marketplace at this point in time. So we have to take all that with a grain of salt. So anyway, let's get involved right now with respect to housing. And by the way, if you're not already a subscriber, if you could help my channel grow, and please subscribe, I would really appreciate it. Thank you very much. All right, guys. So today, again, the big news end of the month comes out, and what do we have? We have, what's called Case-Shiller, right? So it basically is the news, and we take a look at where we're at with respect to housing values. Now, the one thing about Case-Shiller, which we know, I call it a tag-along, drag-along calculation. So here we show U.S. home prices are accelerating at the fastest pace in 2 years. So amid a resurgent U.S. housing market, it's perhaps no surprise that Case-Shiller reports that August, the latest lag data, saw a serious surge in home price across the 20 largest U.S. cities. Against expectations of a 4.2% year over year, it actually reported a 5.18 year over year gain, the fastest pace of acceleration since August 2018. So basically, what we have here is, Case-Shiller beating expectations. But note, though, it says, finally, we note that yesterday's new home sales for September did disappoint, and we'll talk about that in a second here. But again, just, this is what's going to be talked about right now in the next few days, is the fact that housing market is doing great. Well, it's doing great if you're one of the few people that are selling their homes, right? It's all based on sales data and sales pairs. Less inventory is causing competition. So again, this is the formal release from, you take a look at the S&P Dow Jones, CoreLogic, Case-Shiller, U.S. home price index. All right, it's a leading measure of U.S. home prices, August 2020 data, and basically, one thing too. It looks like July data for Wayne County, Michigan's available, so they're going to start to catch up on some of that information here. I guess you could say our biggest, winners for, I guess, house values, you could say, were really Phoenix, Seattle, and San Diego. Phoenix has always been up there, and it's going. Phoenix led the way with 9.9% year-over-year price increase, followed by Seattle with an 8.5% increase, and San Diego with a 7.6% increase. All 19 cities reported higher price increases in the year ending August 2020 versus the year ending July 2020. So we've had a little bit of a uptick in some values, which seems to be making sense. Here is your chart. Obviously, you've got three different lines. You've got the national index, which is the dark, thick line. You have the thin line, which is the 10-city composite, and the dash or broken line is the 20-city composite. But so they run different indices. So ultimately, we look at charts for the 20, and then we talk about the overall in national average as well too. But you can see where we peaked, where our peak was, the first peak, and then we trough, and then now we're back above that peak, and that's that's a certain increase in home values across the board there. So let's take a look at how that played out. So we are 21.3% above the last peak, which was 2006. I like to always sort of qualify this. We said we were in a housing bubble in 2006. So if we go to the 2006 bump, everyone agreed that was a housing bubble. Why can't we say it in 2020? I don't get that. So why is that not a good word to say? Why are there journalists and people who are sort of squashing that concept? We know the narratives. We know what's going on now. The changes we have in our environment is all about controlling narratives. So if we are 21.3% above the last peak, I'm calling it a housing bubble. I say this every video. People still, I guess you could say, I don't know what the word is, dispute it or don't want to agree with it or don't want to acknowledge it. There's nothing wrong with acknowledging it. Housing bubble is a housing bubble. It's just what happens to the housing bubble. That's where the fun begins. So again, we are 21.3% from the 2006 peak. All right. If we go on an individual basis here, we can take a look at Atlanta was a 5.1% year over year increase. Boston 5.7%. Charlotte 6.7%. Chicago only 1.2%. Cleveland 6.9%, Dallas 4.2%, Denver 5.3%. Detroit doesn't have any data. It just started getting some data from July. So it's good. We're going to have a few months of data, I suppose, coming in before they can start putting the Detroit information on this chart. Las Vegas 4.7%, Los Angeles 6.8%, Miami 4.8%, Minneapolis 5.8%, New York 2.8%. Phoenix was a leader at 9.9%, so almost a double digit. Portland 6.2%, San Diego 7.6%, San Francisco 4.1%, Seattle remarkably 8.5%, Tampa 6.9%, Washington D.C. 5.7%. So our 10 city composite index rose 4.7%, our 20 rose 5.2%, our U.S. national indice rose across the board 5.7% year over year from August 2019 to August 2020. All right, so there you go. So we can see that everything is kind of in the mid, like 4 to 5s. We got a couple outliers, 7s and 9s, almost 10% there. At some point in time, things are going to have to level off. We can only go so far and we can only sustain so far. Okay, and this is interesting because Wolf Richter of Wall Street actually had an article that came out a couple days ago. And it's interesting because, I look at things from a bubble theory perspective. And right now we are in that bubble theory. In other words, people are, everyone's heralding this great increase in prices. Everything's great. The market's wonderful. We have low interest rates. Why shouldn't you be buying? There's just it's the pressure. I mean, I talk to people every day, and everyday buyers are getting pressure from their real estate agents to buy because you don't know what's going to be next month or then 2 weeks from now. So a lot of stuff going on, a lot of confusion, and I think it's very difficult for a home buyer to sort of ascertain what the market's doing and try to figure it out. People will comment saying, well, if you bought a year ago, you'd be better off. Well, maybe you would be, but what happens next year? Maybe you'll be worse off. You don't know, and that's the problem. The timing is everything, and we don't have the crystal ball, but as I always say, we have the time machine. We can go back in time and take a look at what went on and see if we can make correlations, see if it can help us make educated decisions about where the market's headed and how it's going to fall apart. All right. So basically, what Wolf Richard's saying here is it crazy in the sense that the housing market, or rather part of it, namely the higher end, has gone totally crazy, and that by now everyone knows that this isn't sustainable and that there's no way it can last forever. As Redfin CEO Glenn Kelman told CNBC, he pointed out what everyone has already been pointing out, that part of what is fueling this boom is that the economy has split into two. Rich people are able to access capital almost for free, so of course they're going to use that money to buy homes, which is kind of an interesting thing. But there's another group of Americans who are still struggling, who can't access credit because we've raised credit standards and you have high unemployment. I think those two trends at some point have to collide. So that's CEO of Redfin kind of saying, this isn't going on forever. So the housing, hype dudes who are out there, there's got to be some realism here, and that's what we're looking at. So again, I agree. Half people are thinking this is still going to continue. Everything is great. Other half, which I'm in the other half side here, knows that at some point in time this is going to end, And then that's where things change. So, are we preparing for that? Or are we just going to stick our heads in the sands and stick with the bubble mentality that everything is going to be good and nothing's going to go wrong? I mean, that's what you have to look at. So, interesting point here, though, is that there is a shortage of supply until there's a glut. And this always happens or always surprises people. So Wolf Richter says this is happening in San Francisco, and something similar is happening in Manhattan and some other cities. The city was long described by its housing shortage that drove up prices and rents, though there have been plenty of housing, but all high priced and people couldn't afford it. And suddenly that housing shortage has turned into a glut. The city is flooded with a historic amount of inventory, including a record-breaking number of condos for sale, and there's a large offering of vacant apartments, and rents have plunged, with one-bedroom rents down 19% in 5 months. So, what typically happens after we hit our peak? Well, people go, I better put my property on the market. And then there's more property, which means there's more choice, which means there's more flexibility in pricing, there's more negotiation, prices will start to fall. But very interesting point here that he's making is the fact that, we have the housing bubble because it is truly supply and demand, fueled by low interest rates. And guess what? And the bubble, fear of missing out mentality, which I talked about on last video. And now we are having some situations in certain locations. And listen, it always starts off with the mega cities. And what do I describe as the mega cities? The San Frans, the LAs, the New York areas, the Miamis, whatever. That's typically where we see stuff kind of fall first. So we know that Manhattan and New York City has a glut of apartments and condos available. Okay, we know there's problems there. And underlying, they've got a ton of pre-foreclosures as well too. So, and rents are plunging. Rents are going down quickly. And, what landlords or housing complexes are offering to people are, free this, free that, benefits here, bonus here, whatever. So they're incenting people to jump in and rent. So now is actually a pretty good time if you want to sort of run that trend downward and see what you can get. But this is the thing. Everything peaks and peaks, and then suddenly we see a little change, and this is the change right now. So this is interesting. So it shows that the inventory of homes for sale spiked from shortage to glut in a matter of months. So as of the week of October 11th, there were a record 2,476 homes listed for sale, up 72% from the same week last year, with condos accounting for the lion's share. Note how the glut has blown all seasonality out of the water, and this is a chart from Redfin. So, if you take a look at the red is 2020, the teal is 2019, gray 2018, and black is 2017. So we can take a look at where we are now. That at the peak, which would have been in 2019, we were, San Francisco was sort of looking at about 1,500 active listings. Well, now we got 2,476 active listings. So in San Francisco County, so that's a significant impact. So it's not 5% or 10%. That's 72%. That's a pretty big number. And again, that just shows that things are going to change. Now, are people bugging out and buying first and trying to sell first? Maybe they are. But the point is, we're going to start to see some of these shifting patterns now in the larger cities. It always starts with the larger cities, as I mentioned. Eventually, it'll work its way out to other locations, and then we'll see how that manifests itself with respect to who's leaving where and where are they going to, and how those two markets play out on each other, you see. So, very interesting here. So, I like how he puts it, though. He basically says these gyrations in the housing market are occurring at the lower end. Homeowners are steeped in turmoil, nearly 7% of mortgages in forbearance, according to the Mortgage Bankers Association, with delinquency rates of FHA-insured mortgages, which cater to the low end of the market, skyrocketing to a record 17.4% in August. Any day now, we're going to see the September report. It's coming out. I actually tried to pull it up before I did this video, and it wasn't out as of yet. So we're going to see that 17.4% increase for sure. Okay. He's saying 23 million people still claiming state or federal unemployment insurance. That's part of the K-shaped recovery. So we're seeing high-end stuff, price going up, great Case-Shiller values, home prices, whatever. But this other part, the lower part of the K, the part of the letter pointing down, still hasn't hit us yet, but we know it's stacking up. So surging home prices like these are a terrible toll to pay for buyers, except for those where wealth is such that doesn't make a difference. As these home prices surge, the market will inevitably run out of buyers willing and able to buy, even at record low interest rates, especially in an economy like this. In addition, there is a lot of supply waiting in the wings, including a portion of the homes whose mortgages are in forbearance and delinquent and will have to be sold to cure the delinquent mortgage. Homes whose owners moved into their recently bought new home will end up on the market, and homes owned by investors or for vacation rentals will end up on the market if vacation rentals continue to be a drag in those cities. This surge in supply can happen suddenly, as it's happened in San Francisco. So yes, we know that there's delinquencies in mortgage. We know that there's forbearances out there. And we know, well, listen, maybe you don't want to know, but we know that the 4 million people or 3.4 million, whatever the forbearance number is, underreported probably at best. And we know that every single one of those people aren't going to have mortgage solutions that get to keep their homes or sell. You're probably going to see at least half, if not more, people will fall in the foreclosure process for sure. So, and it doesn't count the other people that aren't even in forbearance, the million plus there, and all the mom and pop landlords and other things that are going on. Okay, so please understand that the housing market's not rosy. It's rosy if you want to look through the rose-colored glasses right now and say, hey, I'm going to buy a property now because in 6 months I'm going to gain 10%. Well, that's the wrong mistake to make. Buying at the peak of the market with low interest rates when we're starting to see the cracks in the large cities, that to me is the big sign right there, people. So you got to keep that in mind. All right, so that's his take on it. Interesting enough, now new home sales tumble in September as average price hits record highs. So of course, this is the new home sales. They're a different statistic, okay, and they're always revising it, so it's tough to really figure out what the deal is. So ultimately, in the end, everybody's looking to the new home market to be part of the savior of the real estate industry. Problem with new home sales is the fact they can't build enough of them. They can't build them fast enough to absorb the need, and also they can't build them in the price points that are really required. Where are the price points that are required? The affordable home, sub 250K level. That's where people need that market segment. Why can't they do that? Well, number one, public companies, they have to make money and earn for their shareholders. Number two, land costs are up. Entitlement and development costs are up. Labor costs are up. Material costs are up. Look at lumber futures. If you guys want to know about the housing crisis, always also look at lumber future pricing, okay? Lumber futures have gone up big time, especially now since we've had a few more wildfires over the past few months. That causes some chaos with lumber futures, which basically means your per square foot price to build a home is going to increase if you're a builder. Now, home builder sentiment is up because they go, hey, we build it, they'll come, because there's not a heck of a lot of choice out there. But I do think it's interesting, though, that despite what they're saying here is, despite this surprise surge to multi-year highs in existing home sales, new home sales were expected to rise only a modest 1.4% month over month, but things were notably worse in new home sales, tumbling 3.5% in September, and August high bounce was revised down as well too. So there you go. That's the thing. So we always hear statistics for new homes, but they always revise them. It's never as good as when they talk about them, all right? This move takes the revision of the seasonally adjusted annual rate back to below $1 million to 959K in September versus 1.025. So again, we're putting 1 million homes or building 1 million homes for the year, under 1 million homes for the year 2020. Now, how does that represent the marketplace? Well, let's just say if we're on for existing home sales, which is stuff on Realtor.com and the MLS, if we're running at a 5.5, 5.7, maybe 6 million, seasonally adjusted number for the year 2020, and we've got under 1 million, okay, so we're looking at it's either 1/6, 1/7 of the market is new homes. So that's not huge. It's not 30% or 40% or more. Whatever that number is, 1 divided by 7, I forget, what I'm thinking of, maybe 12% or something like that. 12, 13, 14%. Okay, whatever that, I'm not doing, again, I don't do math in public. I've said that many times here, right? But the point is, unfortunately, the new home sales group segment can't supply enough product where it needs to be supplied. And, therefore, that's just the way it is. So, again, what we've seen, though, is that even though they missed some sales, so they were down, this is the median price, basically, is ticked up from 322 to 326, and that was your drop. Sorry, that's your drop in volume. So the volume went down a little bit on this slide, and then the median price did go up a little bit from 322K to 326.8K. So what we're seeing is the average new home price is increasing. You can see from 2019, sort of mid 2019, to where we are today, it's gone up significantly. And again, that just goes to show that, what for the needs, like who knows, right? People want to move, people want new homes. What's the great thing about a brand new home? Well, it's brand new, and you've got a builder warranty, and you're not having to do repairs or maintenance for a number of years. You got a new roof, you got new appliances, you've got new plumbing, you've got new flooring, you got all these new air conditioners. I mean, you got a lot of great things. So that's a very attractive. But we're not building enough of them, and we're not building them in the segments that need them, which is affordable housing. All right. So, but again, I still think it's important to show that. So the home builders, their sentiment's very high. I don't think that really reflects as to home buyer sentiment's not as high. It doesn't reflect the same way the home builder sentiment does. And the point is, we still see price gains even on their end. So we have existing home price gains, median-wise. We see Case-Shiller going up, and then the average new home price goes up every month as well too. So basically, everything is increasing in price. When will it become unattainable for the average person to buy something? All right. Just out of curiosity, I started looking. I do look at the commercial stuff, and this is outlier information. We talk more about residential stuff right now, but we got to talk about how this is going to affect. I pulled this up because this is New York City. So look at this. New York City hotel occupancy rate crashes towards 10% as permanent closures loom. And so this is an example of how, one problem in a real estate segment will have a domino effect in the other parts of the real estate, segment. Okay. So basically, some hotels have remained closed since March. Others operate at limited capacity. Those that are open for business have slashed prices more than 60%, according to a new write-up. Despite October usually being a fruitful month for tourism in New York City, coronavirus has forced the cancellation of staple events like the NYC Marathon, Fashion Week, etc. And while the industry has definitely recovered since March, it still has a long way to go. 200 of New York's roughly 700 hotels remain closed, the article notes. That's a lot of hotels. Okay, so basically, occupancy rates in New York City stand under 40% right now. The average daily room price is $135. Last October, it stood at 92% as occupancy and $336 for the average cost per night. So we're looking at this being cut in half, basically. So your occupancy is down. It's almost down. If it's 92% and we're under 40. We're almost down 2/3. We're probably 50 plus percent here, 50 to 60%, and the rate basically has dropped more than 50% on average. So to me, this just shows that and again, there's other issues going on. We realize that in a big city like this, so that's probably having also impacting like who's showing up. But how does this all play out? Well, if you're having that many less people staying, that means they're probably cutting staff or laying off staff or cutting hours, which means people now either can't pay their rent, can't pay their mortgage, etc. So this is a trickle-down effect from what's happening. So executives in this industry basically predicted up to 20% of the city's hotels could wind up permanently closed. You know what I mean? Like, so basically, and what the hotels now are offering are limited services now. Room service stops after breakfast, and the concierge clocks out at 5 p.m. That's just from this hotel in the picture here. But the point, though, I'm trying to make is the fact that, guess what? Like, this is commercial, and the commercial mortgage-backed securities are out there, and we know that certain segments of the commercial mortgage-backed securities are having big-time default and delinquency as well too. So that's posing problems, and that's going to cause vacancies and things to shut down, which will have job losses, revenue loss, tax loss, things like that. So it's a much larger, we'll call it a problem when this many hotels in one location, are not operating or operating at such a limited capacity and will be closing down because they can't make ends meet. I know a lot of people are vulturing, going, well, maybe I can jump in and buy something like this at discount prices. Well, you probably can in the next little while, but I guess, is it going to make sense? I mean, will this pick back up at some point in time? We'll have to see, right? Will tourism be back up? How will coronavirus play out? I mean, these are questions that we're all waiting for answers for, and that's going to make a difference on so many levels in the real estate industry, from people who are employed in the real estate industry to property values themselves, and the whole. It just goes from A to Z. So that's how I look at this. So it's not a good scene when you got something like this going on here. So anyway, the point is, I think it's important to point out how that's going to affect us as well too. What's the point? My point is, we're seeing two different markets. We're seeing the K-shaped market right now. So some markets are growing and increasing, and that's great. Yet we know that the other part, the bottom part, the pointing down part of the K, is positioned. It's not here yet. We're in this state of limbo. So I call this like the artificially controlled market, because we're not seeing foreclosure sales. We're not seeing foreclosure filings. Everything is held up now because of the moratoriums that are in place. Moratoria, plural. So when that starts to break open, we'll see more activity, and that we'll see more people at the auction. Hopefully we'll see more property coming back to the market as distressed and cheaper price. That still remains to be seen. All right. So what am I doing about this? Well, you know what? I just want to make sure everybody understands to not get a false sense of where the housing market is headed. So you have to be vigilant in what you're looking at, where you're leaving, where you're moving to, what you want to buy, price points. You have to do your research. You have to reach out and talk to intelligent people that can actually help you, not just giving you the standard, you better buy now because it'll be more expensive, next month, and you're going to miss out. So, fear mongering is not ways to earn sales as far as I am concerned. All right. As I said, two different housing narratives in play here. You understand your market. What do I like to do? Look for off market, look distressed, look to the shadow inventory. The foreclosures are not here yet, but they're behind the scenes. That's the shadow inventory, folks. That's what's stacking up. I look at it going, your real estate agent, because people ask me, well, how can I get my hands on this? Well, you can't unless you do some extra work yourself, because your real estate agents won't, or don't know how, or won't do this because it's too much effort and too much work. Okay, so if you want more information on how we're going to be messing with the housing market, how we're going to get good deals, and how we're going to put people in homes, and how investors are going to make money with us, et cetera, reach out to me. Simple as that. And what I offer is basically consultation. I know people, we've talked many times. I'm talking to people about their personal situations. And again, I'm not looking just on sales. I'm talking to people about maybe whom are in foreclosure or forbearance as well, to helping them. So I look at everything. All right. So just, reach out to me. We've got different ways that we can figure stuff out here. How to get a hold of me? Very straightforward. Is hit me up with my email there. Put your contact information there, and I will reach out to you. Sometimes I get behind. I admit that, because of just volume and stuff I'm doing. So realize that and if you don't hear from me from a while, send another email and ping me, because I do tend to forget. All right, guys. So once again, appreciate the time today. I appreciate the views, likes, comments. Please share the video with family and friends. If you're not already a subscriber, please help my channel grow, because it's being throttled down by the powers that be now. So I'd love some more support from the people out there, and that'd be wonderful. So please subscribe and reach out to me if you want information or discuss your personal real estate situation. Look forward to speaking with you later in the week. Thanks.